Every economic crisis feels unique while it's happening. Different countries, different triggers, different headlines. One time it's banks, another time it's housing, then it's inflation, supply chains, sovereign debt, or technology. Each crisis arrives wearing a different mask, convincing people that this time the rules have changed. And yet, when the dust settles, the underlying logic always looks familiar. The pattern repeats, not because history is lazy, but because economic systems respond to incentives in predictable ways. At the beginning of every crisis, there is usually a long period of stability that feels earned. Growth looks steady. Risk appears manageable. Institutions gain confidence. Policymakers point to improved tools and smarter frameworks. Markets reward this confidence by pricing risk lower and lower. Over time, that stability becomes the justification for taking on more leverage, more exposure, and more complexity. What starts as efficiency slowly turns into fragility. This is where the real mechanism begins. Stability changes behavior. When people believe the system is safe, they stop preparing for outcomes that seem unlikely. Lenders loosen standards, borrowers stretch assumptions, investors chase returns that only make sense if nothing goes wrong. Each individual decision appears rational on its own. Together, they create a structure that depends on everything continuing to work perfectly. As leverage grows, the system becomes more sensitive to small shocks. Minor disruptions that would once have been absorbed now travel faster and further. At this stage, warning signs often appear, but they rarely look dramatic. Asset prices flatten, volatility briefly rises then fades. A few institutions report stress, but overall indicators still look healthy. This is usually when people say that concerns are exaggerated or outdated. After all, the data still looks fine. What matters here is not the trigger itself, but the conditions that make the trigger dangerous. A housing slowdown does not cause a crisis on its own. Neither does a rate hike, a commodity spike, or a currency move. Crises happen when a system has been structured in a way that leaves no margin for error. The trigger is simply the moment when the system is forced to reveal its true balance. History shows this clearly. In the late 1920s, financial innovation and easy credit fueled asset speculation. Margin debt expanded rapidly as investors borrowed to chase rising stock prices. The economy looked strong, productivity was rising, and confidence was high. When prices finally turned, the issue was not the market decline itself, but the leverage underneath it. Forced liquidations amplified losses and spread stress throughout the financial system. Decades later, the global financial crisis followed the same logic even though the surface details were different. Housing replaced stocks, mortgage-backed securities replaced margin loans, complex risk. Models replaced simple credit judgments. Once again, years of stability encouraged risk-taking, leverage accumulated quietly, and institutions became deeply interconnected. When housing prices stopped rising, the problem was not just falling home values. It was the structure built on the assumption that they could not fall nationwide. The same sequence has played out in emerging market debt crises, currency pegs, sovereign defaults, and banking panics. Each time, the story sounds new. Different countries, different policies, different political pressures, but the mechanism remains the same. Long stability leads to rising leverage. Rising leverage creates hidden fragility. Fragility turns small shocks into systemic failures. One reason crises feel unpredictable is that most economic data measures levels, not structure. GDP can grow while risk quietly accumulates beneath the surface. Inflation can remain low even as leverage expands. Employment can look strong while balance sheets deteriorate. Traditional indicators tell us how fast the system is moving, not how well it can withstand stress. Another reason is that incentives reward short-term performance. Financial institutions compete on returns, governments focus on growth and employment. Investors are judged quarterly. No one is rewarded for reducing risk during good times. In fact, caution often looks like incompetence when markets are rising. This creates a bias toward delay. Action comes only when the problem is impossible to ignore. When the break finally happens, the narrative shifts quickly. What once looked like innovation is reframed as recklessness. Confidence turns into blame. Emergency measures replace long-term planning. Liquidity is injected, rates are cut, guarantees are expanded. These responses often stop the immediate collapse, but they do not erase the underlying lesson. The system failed because it was built on assumptions that did not hold under stress. What makes each crisis look different is the surface story. What makes them start the same way is human behavior interacting with financial structures. The belief that past stability guarantees future safety. The tendency to underestimate rare risks. The slow buildup of leverage that feels manageable until it suddenly isn't. Understanding this logic does not allow us to predict the exact timing of the next crisis. But it does explain why crises are inevitable in complex financial systems. As long as incentives reward risk-taking during good times and delay during warning periods, the cycle will continue. The form will change, the language will evolve, the pattern will remain. The most dangerous moments are not when fear dominates the headlines, but when confidence feels unquestionable. That is when systems quietly move from resilience to fragility. And that is why economic crises always look different, but start the same way.